Hi everyone, welcome to another Opto Sessions podcast. I'm excited to introduce Larry Cermak, CEO at The Block. The Block is one of the most leading information services brand in the digital asset space, and it empowers smart decisions about the ever-evolving landscape of digital assets. How are you doing today, Larry?
I'm doing great and happy to be here. Looking forward to the chat.
And where are you calling from today?
I'm currently in Europe. I'm currently in Prague, but we move around a bit recently.
So are you mainly based there, or
recently
you go to the States quite a lot as well?
Yeah, exactly. So I go to the States. We used to live in Germany. Now we've settled a bit in Czech Republic, mainly because that's where I'm from and that's where my wife is from as well. We also are now raising a small family, so we finally kind of settled down and are staying here most of the time.
Cool. That sounds very nice. And I was actually looking at your Twitter account today. You retweeted a tweet, so I thought we could start with something related to Tether.
Of course.
Only because it's not something I've looked into too much before, but the story was about them announcing that they'll invest 15% of their profits in Bitcoin. I was just wondering if you could take us through the significance of that and also how Tether actually makes its money.
Yeah, absolutely. So for those that don't know, Tether is currently the largest stablecoin. It's mostly issued on Ethereum, but it's also on other blockchains, and it just serves as kind of digital representation of dollars on the blockchain. They also have Euro stablecoins, and I believe Chinese yuan stablecoin, but the vast majority of the use is on the USDT version, which is the US dollar representation. And Tether currently has the largest market share, followed by Circle, who had some issues recently that you guys might have heard about, but currently is trading at peg as well. So it's both are trading at $1. And Tether is just a centralized issuer that takes the money that is deposited to their accounts. So it lives on bank accounts, trusts, bonds, and it then issues the stablecoins digitally on the blockchain. And the way that they make money is similar to how a saving account makes money. They deposit it to few of these relatively safe instruments, I would say. The vast majority is in bonds, government bonds, T-bills, and sometimes just in high yield savings accounts as well. And so, they're getting anywhere from 4 to 6% on that these days. And given that they have, tens of billions of dollars issued, it's a very profitable business right now. It wasn't as appealing when the interest rates were low, but now that there's just tens of billions of dollars issued and you just multiply it by whether that be 5%, they're extremely profitable and they have nearly zero expenses. The only expenses is really connected to like operating expenses to actually running the stablecoin itself. And so the significance of them reinvesting some of these profits into Bitcoin is that currently it's probably the most profitable company there is in crypto. Historically, when interest rates were lower, you could look into exchanges as being the cash cow. Like Binance and Coinbase do absolutely amazing in bull markets in general. In bear markets, when the volumes are down 80 to 90%, they're not as profitable as a stablecoin issuer who then is monetizing the money that they were able to get during the bull market. And so because it's insanely profitable and they then put a decent amount of these profits into Bitcoin itself, it creates kind of constant buy pressure that's predictable. So effectively what they're doing is they're moving some of the interest that they earn from these reserves to then buying Bitcoin, and that creates constant buy pressure, which then in theory, should be good long term because again, it just creates natural buy pressure long term, and especially now that they've committed to doing this effectively programmatically, it's almost similar to exchanges like buying back their exchange tokens with their profits. So but in this case, it's for Bitcoin, which is perhaps even more significant because it's not their own coin; it's actually just buying Bitcoin itself.
Yeah, thanks for that. That's really interesting. And I thought we could just also discuss what you thought the outlook is for the blockchain industry at the moment. What's the health of the industry? Obviously, you're quite close to the industry because you work with it day in, day out.
Yeah, absolutely. So, I mean, it's a very loaded question. I would say, over the last year or so, the industry has slowed down massively. There's a lot of concerns about regulatory pressures. A lot of businesses that were not sound have since blown up over the last year or so. And so there's been a lot of focus on just compliance and regulations recently because of that. When you take all of these out, we can look at some of the more fundamental data points that we track on a daily basis. While I'm now the CEO of the block, I was the VP of research up until 2 months ago. So I would track this constantly, and I still do to this day. So we can look at multiple different metrics. For example, when we look at like any sort of retail indicator that we use, which is generally kind of just trying to get a sense of how many retail investors are actually involved, interested. We're not seeing much interest these days from a retail crowd. You could look at few proxies like number of new Twitter followers or number of new subreddit subscribers, number of new YouTube subscribers, page views on Wikipedia, Google Trends. Like those sort of social indicators that we're seeing are all trending low and not doing very well compared to when the market was much hotter. So based on like effectively every metric that we can look at, there's just not much retail interest these days. There's obviously a few of the like meme coins that maybe attracted some, like the Pepe coin and all this like kind of what we call almost like nonsense or not really fundamental, more so just a meme related thing. There was some retail interest, but just not that much. And I think it's kind of consistent with the fact that because inflation is higher, because unemployment is slightly higher, there's just less disposable income for people to be able to speculate on some of these things. When we look at some of the like more institutional indicators, there is some uptick for sure. We've seen some uptick like anecdotally, but also from some data sets over the last 2 or 3 months, very closely correlated to the banking crisis in the US. So when that happened, we've seen, first of all, a few investors just kind of talking about them allocating, but just in general, when you look at like the flow and a few other data points, deposits to exchanges and these sort of things, we could see larger interest from what you could probably call an institutional or a larger investor. And another metric that we look at, which I find very significant as well, because there's just a lot of capital on the sidelines, is how investors, and mainly talk about VCs and hedge funds, how they're actually allocating into venture investments as well. So not just into Bitcoin itself or Ethereum or any large cryptocurrencies, but also deploying into the sector overall. And those numbers are still relatively low, especially compared to the last peak. We're talking about, at the peak it was in $3 to $5 billion range on a monthly basis. Now we're looking at something like 1.2. So it's still a lot lower, but it's already starting to kind of rebound a bit from what it was a few months ago. So we're seeing some slightly encouraging signs, and generally how bull markets and bear markets are. There's generally, kind of a slower period, not much actual activity, not much action, and then there's some uptick for whatever reason. And that's generally followed then by the retail interest jumping in again. But as the listeners probably know, crypto by itself, but Bitcoin as well, and all the cryptocurrencies are insanely cyclical and really, really volatile. And the peaks, the ups and peaks, generally go up 4 or 5x, sometimes even longer in previous cycles, and then you crash 80 to 90%. And it's just something that the industry is now kind of used to, but it always causes like damage, and especially in the last year or so, it just caused a lot of unprecedented damage as well when if a few parties are just over levered and stuff like that, it just causes damage. And we're finally starting to get out of that, where there's just much more enthusiasm. And anecdotally, we're seeing that as well from our clients, and we mostly work with B2B institutional clients. We're seeing that there's now starting to be more appetite again. But Q1 was absolutely horrendous for everyone. It's just like almost no interest.
And outside of Bitcoin, which is typically seen as a store of values, like its main use case, what other use cases are you seeing in the blockchain industry that are, that have the most value at the moment?
Yeah, I mean, there's definitely a ton. I'm personally, Bitcoin is, like you said, it's mainly used for kind of alternative investments. It's used by hedge funds to hedge against certain things, to diversify portfolios. It's mostly just a tool for diversification and investment. Whereas what we mostly research and what we're mostly interested in is some of the innovative stuff that's being built on top of blockchains overall. So what I think, where there's actually the most activity still to this day, it's a few things. It's mostly the financial products built on top of crypto in itself. Mostly the vast majority of activities on top of Ethereum. So that's where we're spending a lot of our time. The most popular use cases are still trading, whether that be spot, so on something like Uniswap, or derivatives and something like UIDX. And then there's also quite a lot of interest in leverage. So lending markets are also very popular. Like those are probably the three pillars that continuously get the most interest when it comes to financial products. And the reason for that is because just like in regular finance, it kind of encourages speculation, and crypto is maybe speculation squared. There's just so much interest in speculating on things, and so these products generally get the most adoption. They take up the most block space. They're the most in demand. Outside of these, when you look at like purely just speculation into financial products, you also have NFTs, which are very much kind of cyclical in itself, almost like cyclical outside of the normal cycles that we're used to. There have been a few now over the last 4 years where it just like pops off massively. CryptoPunks, apes, and other Azukis and NFTs like that. They absolutely like go crazy, and then the interest just decreases again. So the cycles are shorter. It's much less mature than any of the other sectors. But at some point, especially when they're hot, they're taking a lot of the block space, a lot of demand. It was very much in demand, like 3 or 4 months ago. Now it's effectively dead again. So it's just shorter cycles. And then when you look at like outside of NFTs and financial products and look outside of just speculation, there's a few use cases, but none of them have taken off like massively yet. There's like social media that you have built on top of blockchains. Most of the time, it's kind of more so just creating the social layer, so just the connections, but not necessarily the data storage. Then you have the data storage as well, so just trying to distribute data storage similar to what Dropbox does, but in a more distributed way. And then you have a few like experimental things, but none of them have a huge level of adoption, I would say, outside of the speculatory use cases. And obviously one thing that I didn't mention, which is kind of more the infrastructure layer, but there's a lot of interest in layer ones and layer twos. And what I'm personally most excited about, and I have been for the last 2 years, and it's coming together very slowly, but what I'm most interested in are the layer twos, and specifically more the ZK-Rollups that are then enabling the ecosystem to just grow much better when there is actual demand again. The problem that we constantly run into is that whenever there is a bull market or any sort of increased interest, the blockchains just cannot handle the throughput that is required to actually onboard enough users. That then discourages users, creates kind of unfair rules where the larger players or the more wealthy players are the ones that get obviously the benefits of like getting into the blocks faster because they pay more and all that. So I think layer twos, which are now kind of at the very close to a breakthrough in terms of actual usability, I think that could be a huge narrative for the next 2 to 4 years. Just very scalable and also decentralized ways for blockchains to operate. I can go more into detail into how these work, but that's where I'm mostly excited, and that's where I think a lot of the breakthroughs are happening these days.
And what are the most prominent ZK rollups?
The most prominent would probably be StarkNet, zkSync, Scroll, and Polygon is also developing their own. So those are the 4 that I think are kind of like head to head. I'm personally most excited about StarkNet, and Scroll and zkSync are kind of similar. I'm excited about all of them, to be honest. What I'm actually excited about is that this technology is something that really like scales blockchains properly without making really bad sacrifices overall to security and to other things, which generally layer ones do. And what I'm interested in is just like seeing them compete against one another, and then just seeing one of them actually win over other layer ones. That's something that I think I'm mostly interested in. But personally, I'm mostly following StarkNet. There's some nuance between there's some slight differences between their approaches, but ultimately I don't think it's going to care much. I think what's the most important is that they're finally going to be usable soon. They're finally going to be usable by normal people as well, and that's going to allow just an order of magnitude more use cases to be built on top. Because right now it's very limited by just blockchains in general, and that includes layer ones. Like you look at the most scalable ones, like Solana, and then they have liveness failure when they go down for a day or so every 2 months or something, and that's something that is very unappealing for someone that wants to use DeFi on top of these blockchains, that wants to kind of transact in a permissionless way. You really don't want liveness failures. You don't want the blockchain to go down and then like your position liquidated because you had no way to prevent it. So that's what I think is most exciting right now.
And a lot of questions come in often about how do these blockchains actually make real money? Because a lot of them, when they're a lot of it's influenced by the token inflation. Sometimes that's how they pay some of the are there any chains that you think are interesting because of their ability to pay back real revenue to stakers?
Yeah, I mean, look, like ultimately when most of the layer ones only make revenue from the fees themselves, right? So some blockchains similar to Ethereum, they have some burning functionality where a portion of the Ethereum of the fees themselves then get burned, and therefore that creates kind of similar buy pressure as we were talking about Tether. Some blockchains are doing that. The issue is that a lot of the low fee ones, high throughput ones, the fees are just so low that the revenue ends up not being super meaningful compared to something like Ethereum. Like Solana is one example. The fees are 1/100th of a cent or something like that, and you need to make so many transactions for those numbers to actually be meaningful. And I think that's similar across the board right now, especially when there's less demand in a market like this, which is just clearly kind of stagnating. None of the blockchains are generating significant revenue outside of Ethereum and Bitcoin to some extent as well, because there's just a lot of demand to use Bitcoin and the transaction fees are relatively expensive. For layer 2s, it's slightly different. You can then have sequencer revenue, which is kind of like you're sequencing transactions on top. So it's almost like one large computer, like kind of combining all transactions into one. And that's then actually generating a meaningful revenue on top for doing that service. So I think when you look at certain layer 2s, including Optimism, Arbitrum, which are optimistic rollups, and then some of the ZK ones that will be used eventually, they are actually generating decent amount of revenue that then could in some ways be moved to like the holders of the token itself. But a large kind of unresolved issue as well is that when you connect revenues to the performance of the token, generally it's something that projects are kind of hesitant to do because of the regulatory environment. So a lot of projects almost like shy away from doing that directly. Uniswap is one prominent example, but also some layer 2 protocols where they're almost like in some ways scared or not super keen on doing this now because it could make the token a security, which could then make it make it more difficult for them to sell the token. It could also make it more difficult for the token to trade on US exchanges. So there's a lot of nuance there of like revenue by itself is not enough. What actually ends up moving the needle is like how the revenue ends up being distributed, where the revenue actually ends up going. Is it something that the governance can control? Is the system actually decentralized enough for this to be meaningful? Those are like some of the things that you have to look at. And that's like one of the issues and one of the reasons why so someone like the block has a lot of business is because there's not a lot of standardization like you have in normal finance. Like you look at tokens, their performance, the revenue that they make, and you have to make assumptions about who's actually controlling it. What does the governance look like, and just make a lot of assumptions about like does this even matter that they have the revenue? And you have to do this for every single token, every single project, and figure out like, am I going to make money just by people speculating and therefore like me selling for a higher price in the bull market, or am I going to make money in a more sustainable way where even if there is a bear market, there's still a kind of a tangible path for the tokens to be able to get that revenue and then move some of these some of these metrics to the token holders themselves. And I think that's currently the largest issue, is that a lot of tokens don't do that, and then there's very little reason to actually hold it outside of just making some decisions, which generally haven't been like super impactful.
Yeah, definitely need to do your due diligence on everything you do in this industry. Can we just have a quick overview of your sort of career to date, Larry, and also your new role as CEO at the Block?
Of course. Yeah, of course. So I started researching Bitcoin specifically and crypto overall in about 2016. That's where I actually started doing this, almost like you could call it full time. So it's been some time, not like super early. Before that, I was like a little interested in Bitcoin, a little interested in crypto. I invested a bit, but was never like interested enough to like do a proper deep dive. It was always just something that I was like meaningfully interested in. Then in 2016, I was thinking about what to write my economics thesis about in college, and Bitcoin was always something that was like so polarizing, and I always saw like some promise in there, and a lot of like difference in opinion, where it seemed appealing to me. You know, if I'm going to spend 10, maybe hundreds of hours on something, it should be something that excites me, and that's something that, you know, I could learn a lot from. And so I decided to do that into kind of the economic feasibility of Bitcoin. That was the topic that I decided. And then since then, I started doing a lot of research, and I completely like fell down the rabbit hole. It's kind of a meme at this point in crypto, but it really, for me, like I was completely obsessed for like a year straight. I could not do anything else. I would just have to look into like, you know, how everything works. Why do people think this is good? Why do people think this is bad? And try to find kind of the middle ground. And what was really interesting to me that I found in 2016 was that the opinions on crypto in itself were super polarizing. Like it was either the economists that would say Bitcoin is completely useless, it has no economic value, it will go to zero, it should go to zero because it's not sound. And then on the other hand, you had almost like the zealots, the religious cultish members, which would then say Bitcoin is the future of everything. It will solve all the issues that we face right now. It's going to be the only currency, and you should buy all you can get all the time. And what I found interesting back then, and I do to some extent still now, is that there was no middle ground. There was nothing that I found like reasonable enough that would like look at things from the both sides, right? So from both the bad and the good, and try to find a middle ground of like actual rational analysis. And that's what was really appealing to me. That's why I think I fell down the rabbit hole so much. And then after, it was just kind of I was too obsessed to do anything else. Before I was thinking of like working for, I don't know, a consultancy firm and doing economics research or something like that. But after I published my thesis, it ended up getting some attention. And then from that thesis, I ended up getting my first job offer, which was effectively the first crypto research shop. And so I immediately joined, even though the conditions weren't that good, just because I knew I wanted to do this full time, and I knew I wanted to do this as my profession. And so I worked there for a year or so ago, year and a half or so, and started like gradually doing research into different things, not just Bitcoin, started looking more into Ethereum. That was 2017, so things started absolutely exploding. It was like super lucky timing for me because everyone all of a sudden was interested. And back then, it's not like now where each exchange has a research shop effectively. There's like, 3 or 4 competitors that we have that are competing with us on research. Back then, it was no one. No one was actually doing this. So it was good for me. It was like easy to stand out. And what I really did, I think, well early on was that I would share a lot of the research on Twitter. I would start building up my audience. And then that kind of started like snowballing from then. And then 2 years after, I joined the block in, I think it was late 2018, as one of the first 4 or 5 people. I joined the firm and have been there for the last 5 years or so. And my job was like very simple. It was to build out the research team and make it into the most reputable research organization in the space. And I think hopefully we've gotten relatively close to that. I don't want to tout my horn too much.
Yeah. So maybe we could touch on how the block helps investors get better insights into the digital asset ecosystem.
Yeah, I mean, that was kind of our mission since day one. Back then, I remember like the media wasn't super reputable. You had a similar issue where like CoinDesk back then I thought was like too cheery, and then the mainstream publications were too doomy. So we try to, again, be something in the middle. Since then, CoinDesk has improved massively, and there's also more competition. But our mission was really like to educate investors and to be the rational, media in this space. And then media for us meant, have reliable news that's fast, that's accurate, and then on top that being informed by the research. So we always we had the research team that was like helping figure out, okay, this is an interesting topic, we should be looking more on the news side. And then, this is also an interesting topic, we should be researching a little bit more. So we started more of like orienting on just building a reputable media firm. And then as time went and as there started to be significantly more institutional interest, that's where we really found our bread and butter for the research services and the data services as well. And this kind of started taking off really, really bigly when Tesla announced their Bitcoin acquisition for the first time, which I believe was like early 2021. Ever since then, we've grown our customer base from a few hundred to a few thousand. And we're working with the largest firms on Wall Street to try to inform them about how to think about crypto in itself. So we do everything from subscription-based research to custom services, due diligence for larger investors. And then we also now have data that we're providing to these customers as well. But our bread and butter really is to work with the B2B institutional non-crypto clients and help them navigate the space, which I think, as you said, is like pretty chaotic. And for someone that doesn't do it full time, I can't even imagine. Like we have 30 people on the research team, and each person focuses on their like small niche, and it's still a full-time job. It's just impossible to navigate the space if it's a part-time, thing, or just kind of on the side. And so you need people to help you navigate it, to help you make good decisions about where to allocate your time, resources, and that's what we try. That's what we try to do.
Yeah, and you can only imagine how in the next bull cycle is going to be about 10x probably the news that you could cover. So,
yeah, that's right. What I remember, when we started 2018, 2019, we had some days on the news side where we would like struggle to find stories to actually cover without going to the like nonsensical articles like XRP went up 15% because Brad, the CEO, tweeted or something. And so that was a bit of a challenge. I think now, we've grown the news team from about 6 people to I think like 30 plus at the peak. And now we never have these issues. Even in a slower market like this, it's always on a daily basis. You easily have like 10 to 15 stories that you can cover that end up actually being meaningful without covering stuff that people are not really interested in. And so, when people ask kind of like, how is this different from the last bull cycles? Last market, I remember 2018, 2019, like no one really knew if crypto would actually survive. Like it was like such a long and gloomy period where no one really was interested, everyone pulled out. Whereas now, there's less interest, but there's still a lot of like really large companies actually still investing, still being interested, still working on projects. And there's just a lot of announcements, a lot of things happening. Same on the research side. Like we have, like I said, more than 20 researchers, and it's difficult for us to actually cover everything properly. We have to have people focus on very small niches so that we're trying to kind of cover everything that's actually important.
And I wondered if now we could go into a few of the key metrics you use to follow the crypto industry, as data has become one of your key pillars of block. Yeah.
Absolutely. So we also, just for anyone that's listening that's interested in data, we also have a free data dashboard that's not monetized in any way on the block.co/data, if anyone wants to check that out. So a lot of the data things I'll be talking about, you can all that you can find there. But a few things that I'm looking into just on a macro level. So just in terms of like trends and long-term trends, a really important metric, which is kind of evergreen, is just exchange volumes. Looking at both spot and futures exchanges, just looking at the development of the trends. Like right now, we're seeing like 70 or 80% less volume than we were seeing at the peak. It's just a good proxy of how much people are actually interested in trading this, the activity of market makers. When you look at market data, you could also be looking into, for example, a ratio between how much Bitcoin and Ethereum is traded, or Bitcoin versus other coins are traded, to look at like what's actually driving the market. But generally, when the Bitcoin Ethereum ratio goes up, it means that or goes up or down, you can then get a good sense of like, is this rally actually driven by Bitcoin buyers, or is it driven by something else, more like speculators speculating on different things? So these metrics we look at all the time. There's also on-chain data is also useful for just a proxy of activity. You could look at specific on-chain data, like like the total volume of Uniswap swaps. You could look into total number of transactions that are happening. You can look into revenue numbers for both Bitcoin and Ethereum as a pretty good indicator of the health of the ecosystem itself. The metrics that I like personally and that I track pretty religiously is the social metrics. I find that to be a really good indicator. I think I mentioned a few of these already, but there's just a bunch you could look into, like Google Trends, look into website traffic of exchanges and combine all of that. The Wikipedia page views, new followers for Twitter exchanges, YouTube subscribers for the YouTube influencers, and get a really good sense of the flow between what retail customers are and what institutional customers are doing. And there are a few other metrics that you could use as a proxy for, like, for example, you could look into a discount or a premium on the Bitcoin price of just the spot markets versus the futures market, and figure out like is this actually driven by just people speculating the price, or is it driven by a lot of spot buyers? There's just a lot. Yeah. Mm-hmm.
When you say futures market, is that open interest? Is that the indicator for that?
Yeah, open interest is one way of just like seeing how much kind of money is there. Volume is another one. So those two are by far the most meaningful. And when we are looking at we're also looking at prices. So you could have the index, the price at which the futures are trading at versus the price at where the spot is trading at, and figure out, is someone actually just buying a lot of spot, which would then mean that there's maybe a premium of the spot rate over the futures rate that you see in the market. There's just a lot of data that you could be looking into on a micro or macro level basis. But I generally like to follow a bunch of the charts that we have in the dashboard, just more so for the macro level of like health of the industry. So like when you see a rally like this that happened over the last 3 months or so, in my opinion, driven by some of the banking issues that we had in the US, you could look into like, does this rally actually have some legs? Like, is there a lot of spot buying? Is there a lot of follow on it? Are retail investors coming back? What's fundamentally different in the market? Like, are any metrics actually going up or down? Like, those are the things where I actually use the dashboard the most. It's like try to kind of explain and figure out what fundamentally changed in the market, and are things kind of trending up a bit. And we're seeing a little bit of an uptick, but it's still, things are still relatively low compared to the previous cycle. So but it's just a good indicator for you to get a sense of like where things are heading, which things are getting adoption, which are not, and then you could be tracking on-chain stuff as well, much more granularly, like looking into specific applications, how much transactions are happening on layer 2s versus layer 1s. Like, there's just a lot. I can talk about this for a long time, but I think generally it's better to just rely on data to kind of guide your thesis a little bit more and guide your conviction a little bit more than just dealing with things from just anecdotal evidence of like, oh, this investor said they're investing. Like, always looking into like, is there actually a lot more spot buying on a particular exchange? Is CME getting more volume? Like, that sort of stuff is generally what we do as well.
Yeah. And in terms of stablecoin volumes, are there any insights you gather from them? Like if they're particularly spiking, is that bullish or bearish?
We definitely do. So we look into a few metrics when it relates to stablecoin. One is the on-chain activity. So looking into like how much they're actually moving on-chain, which could mean that they're moving from one exchange to another. They're being used for sending money between exchanges. So it's a really good proxy of, generally market makers use them a lot, but it's a good proxy of just general activity, trading activity in the overall industry. The metric that I like the most is just deposits of stablecoins on exchanges themselves. That's something that I think like is a really good indicator of how much money is coming into the ecosystem. So when you think of like investors and they want to get exposure to crypto, the first thing they generally do, is either deposit a lot of money on Coinbase and buy there. But if they're international, generally you would then go to stablecoins first and then go into some other crypto. And so if you look at like the on-chain metrics are good, but they're not as indicative. I think what's very indicative is the total issued supply. So look at like how much actual stablecoins dollars there is in the ecosystem, and if it's going down a lot, which generally happens after bull markets and bear markets, it means people are kind of going back to fiat, which means that they maybe gave up on crypto in itself. But when the number is going up, and historically it hasn't actually decreased much, it generally kind of goes up because then people deposit money, maybe they exit to stablecoins, but they still at least keep it in the ecosystem, and it always provides the dry powder for the next round or whenever there's a next larger opportunity. So that's something I track very closely. And if there's a lot of like issuance happening for both USDC and USDT, generally is a good indicator that there's more money flowing into the ecosystem. So it's definitely something that we watch closely. But there's a lot of nuance for everything. Like, for example, Binance is now using one of the smaller stablecoins called TUSD, TrueUSD, and they're incentivizing people to trade those pairs because there's 0% trading fees on those. So then you maybe see like some outliers of like this stablecoin is now like all of a sudden more important and it's taking away a little bit more market share. So I tend to look at things like more holistically. It's like, what's the trend across all of these? What's the volume of all of these on the on the exchanges? Like, what are the outliers? Like, those are the things. But I think in terms of being the most indicative, looking at the new issuance as well as new deposits to exchanges, that's something that I like a lot. But one last thing I'll say, there's always a lot of what we call like on-chain psyops, is that if someone actually wants to mislead you and let's say deposit $100 million on Binance and make you think that Bitcoin price will go up because this money will be used to buy Bitcoin, they can do that to like try to cause that reaction, because then other traders could speculate that that's the case, and then price will go up without you spending a single cent. Like, those things happen a lot, in my opinion, where like on-chain metrics are never foolproof, and they can be used in very effective ways to cause panic or to cause a trader to do something that you want them to do if they trust those actions. So I would be cautious about like trusting this data fully, but it's still like one of the indicators that we look at for sure.
Got you. Okay. So the longer term trend is probably more important than a daily spike or something like this.
Yeah, that's right. And then also like one thing that we do, but this is kind of difficult to do if you're just a normal retail investor or a small fund, is that we also have a huge database of tagged addresses on Ethereum and other blockchains where like we know what each entity is doing. So if we're following Jump Trading, we're following Wintermute and a few entities like that, or then larger funds, we can then get a pretty good sense of like what they're trying to do. If they're depositing a lot of money, maybe they want to provide more liquidity. If they're actually withdrawing a lot of money, it could be like, oh, there maybe is a small issue or there's a risk that we're not aware of. So we're doing a lot of that microanalysis as well, where we have just a lot of entities like market makers, funds, individual people tagged, and then based on their activity, you can make some assumptions about what's going on in the market. But that's more, what someone like us will do, or on-chain investigators will do, not necessarily something I would recommend for like, retail investors to follow, because it's just messy. You have to constantly find new addresses, tag new addresses. Someone like Jump doesn't want us tracking them, so they will, be smart about doing things. So that's another thing that we do, but it's difficult to do if you're just an individual.
Yeah, no, but it's good to understand. Yeah. Could you explain to us the significance of ETH moving to proof of stake and the new ETH burn?
Of course, yeah. Super high level. Generally, the biggest criticism of crypto when you talk to people that have a very high level understanding is that there's a lot of energy, what they call wasted on these blockchains. And so proof of work is what Ethereum switched from, and they switched to proof of stake. What proof of work does is that you effectively have to do these calculations, almost like solving different puzzles. And by proving that you solve it, you then earn a reward if you're lucky, if you're one of the lucky ones that ends up winning it. That ends up being very intensive for energy, because you're just doing something kind of on top to prove that you're actually there. but it's not actually like necessary for the transaction to happen or for the transaction to be valid. So it's doing a lot of calculations on top that some people view as unnecessary. And so the largest significance of this is that by Ethereum switching to proof of stake, they now spend something like 99.5% less of energy than they used to before, and therefore, for like funds that are only interested in like green initiatives or are environmental friendly, they would never invest in Bitcoin because they always had the issue of like it's not environmentally friendly and it's burning a lot of energy that's maybe not necessary. With Ethereum, it's kind of takes that back, where now it could be an investment that you make because it's all of a sudden being like conscious towards what it's being spent on. So I would say that's probably the biggest significance of itself, is that you don't actually need to do all of a sudden like do the proof of work. You can just go to proof of stake, which is much less intensive. When it comes to the burn, I mean, that's significant for the similar reason I mentioned with Tether. What it does is that a portion of the fees that are derived from the transactions that you're making are then kind of burned from the total supply of Ethereum, and so you're effectively making it more appealing to hold Ethereum long term because the supply actually might not be inflationary, it might actually be deflationary. The supply might be decreasing, therefore there's less supply to buy long term, and therefore you could be more incentivized to buy because you think that if there's a lot of economic activity, the value of Ethereum will be higher. One thing I didn't mention with proof of stake, which is also quite important, is just from like a financial perspective. You can now be earning by just staking Ethereum. You can be earning passively, effectively. If you're staking yourself, there is some small risk that like you get slashed and you lose a small portion. Or if you're using external providers, but it's created, you could effectively collect the inflation. Whereas before, when you talked about miners that are mining proof of work chains, all that money goes to miners, and those miners are then selling the Bitcoins or the ETH they used to sell, because they have to cover their energy expenses and their expenses for personnel and for all these things. So you're almost like, the people that are staking, if I'm the one that's staking, I'm a long-term Ethereum holder, I'm less likely to sell that ETH that I earned from the stake than if I'm a miner, because I have to cover my expenses. You actually have to sell a large portion of it, which then creates more sell pressure. So it's also much better economically sound, from that perspective, because the long-term holders are almost like, you're not necessarily actually selling the earned ETH, and this is. Proof of stake is the consensus mechanism that's used across the vast majority of blockchains. And it was something that was planned with Ethereum for years and years and years, and it finally happened last year. So economically and environmentally, I think it's quite significant. And with Bitcoin, you talk about kind of like it's a fixed supply, but there's still inflation that gets cut in half every 4 years. In Ethereum, if there's a lot of economic activity happening on top, it's possible that the supply is actually decreasing, and therefore you're making kind of more economically sound to hold long term, as long as you believe that the economic activity will always be there, or that will be there or be increasing.
Yeah. Okay. Thanks for that. Now, obviously, recently there's been a lot of regulatory things happen in the States, not on a particularly good level for crypto. They're taking quite an aggressive approach on it. Do you think there's a lot of risk still there in terms of potential bad news for the sector, or is the worst past us now?
It's a really good question. I wish I knew. There's just a lot of uncertainty, and what happened with FTX, which is an entity that was active in lobbying in the U.S. It was an entity that was like in some way like overseen by the SEC, overseen by other like regulators like CFTC is where they were applying for licenses. That just created such a target for every single thing in crypto, where like you could have someone that's you could have the CEO of that exchange in DC 4 days a week, and that exchange then ends up being effectively fraudulent. I think it's very difficult to get that trust back quickly, and that's what we've seen over the last 6 months or so, and I think we'll continue seeing that. It's just that there's going to be more scrutiny against US-based projects, US-based exchanges. There's going to be more scrutiny for everything. And I don't think that's over yet, unfortunately. You could see that with Binance right now. Binance is, now by far the largest exchange. FTX was obviously kind of the up and coming competitor. They failed. And now, I almost see Binance as like someone like Libra, where when Libra came out of Facebook, it was just like no regulator was talking about anything else, like the threat of currencies, the threat for central banks. I almost see that with Binance now, where there's just so much regulatory attention on them because it's kind of, they're international, there's not much oversight. And even if they're behaving properly, it's almost like, the regulators want to know more details. They want to know where they're based, or, they want to know why they serve customers, U.S. customers in the early days. There's just going to be a lot more attention, which could be both positive and negative. But I don't think it's over yet, unfortunately. There could be large actions. On top of that, you have the SEC, and Gary Gensler are like probably the most aggressive he's ever been over the last 6 months. Just yesterday, he's just going by one, effectively saying most tokens they're trading on U.S. exchanges outside of Bitcoin are securities, and they're starting to roll out with a few actions. There's just much more scrutiny, much less certainty overall into what the actual regulation will look like. Like there's just so little guidance and so little clarity that a lot of projects just give up and automatically launch in the Switzerland or Caymans or previously in the Bahamas, is because there's just so little certainty with what you can do in the US. And there's a lot of oversight these days, a lot of enforcement actions, and I think that will continue happening as well. There's going to be a few very high-profile lawsuits, like the SEC going, Coinbase going against the SEC. I think is going to be the industry-defining kind of result eventually when it actually resolves. And I think it's very reasonable for crypto companies and crypto projects to want to have clarity, and there just hasn't been much outside of saying that everything is security. So I think that's happening. And then the last thing, which like there's still some things happening in progress and otherwise, is just stablecoins and regulations of stablecoins and how they will be eventually regulated. And then secondly, also kind of KYC of exchanges themselves. Like, will you be allowed to send money from an exchange to an address that's not identified in some way? Like, I think that's going to be a big focus as well, and continuing to be a big focus. So I'm not anticipating this for any of the regulatory interests to stop, but I do think that like, and when it comes to like, have we seen the worst? I think to some extent I'm kind of cautiously optimistic. I'm also cautiously optimistic that Coinbase, as well as potentially Ripple, will just force the SEC to give more clarity around like what projects are allowed to do and what they're not allowed to do in the US, which I think is very much needed.
And if we assume that the US continues this approach, maybe at least for a year or so, my question then is, how important is the US to the success of the blockchain industry globally?
Yeah, it's a good question. I mean, historically it has been, because there's just a lot of capital, a lot of retail investors that are generally like interested in investing in crypto. It really depends how wide-ranging the regulations are. Like if in the US all of a sudden it's like it's illegal to trade anything outside of Bitcoin and Ethereum, and there's just a lot of oversight of what exchanges and users can actually do and hold, that could be quite devastating, I think, short term. If it's just you use US exchanges just for an on-ramp, and then use on-chain exchanges or offshore exchanges to actually invest in projects that you're interested in, that I don't think that's actually that bad. That wouldn't be such a devastating part in itself. But we've already seen the vast majority of projects as well as companies just migrate away from the US. You see Coinbase now much more active in setting up offshore entities. They're now interested in like entering Dubai as a market. They're launching perpetual swaps, which Coinbase, 2 years ago, if you asked someone, they would tell you you're crazy if Coinbase is launching perps. You just see much more interest in companies wanting to get out of the US and diversify against that regulatory uncertainty. And with projects, this has been happening. There's almost no project that actually wants to be based in the US. Like, if anything, the projects do all they possibly can to be as little associated in the US as they possibly can. They don't want to have their market makers based in the US. They don't want to have in some cases don't even want to be voluntarily listed on US exchanges because it just exposes them to more risk and then potentially more enforcement, potential criminal behavior. It could be eventually there's just, this has been gradually happening. There's very few companies that actually just want to be based in the US these days, and it's only becoming worse. And I think it's mostly like if we just believe that crypto will kind of stay and live and not die in the next 30 years or so, I think it's quite a bad move on the US part that everyone now is going to Dubai, to Singapore, to Switzerland, to other jurisdictions because they don't have any other choice. And a lot of these companies would want to be in the US if there was clarity, but they just don't have it.
Yeah, let's hope they change their approach at some point soon. Well, Larry, thanks so much for the interview. It's been great to chat through the blockchain industry review. Is there anything you'd like to say to the audience before you leave? Maybe you can touch on where they can follow you and the website for the blog.
Yeah, absolutely. You can follow me on Twitter at Lawmaster. You can also look at the block site. We have news and the data that's fully free without any subscription. And then for any institutional audience that's listening as well, if you have research needs or research projects, feel free to reach out to us. We also have the research subscription. We have research services, consulting units, and all that. So feel free to reach out to me personally if you want. And you can also find me on Telegram at Lawmaster10, Lawmaster10.
Thanks, Larry. That's been great. Have a good day, and I hope to catch up again soon.
Yeah, thanks a lot, Dad. This is great, and I appreciate your time as well.